Hey, welcome to the show today. Now, a recent survey in the UK indicated around 30% of financial advisors will be retiring before 2025. A further one-third will be exiting in the next 10 years. That's crazy. So 6 out of 10 will be gone in the next decade. Now, a survey closer to home here in New Zealand by Financial Advice NZ, conducted in 2020, showed that just over 50% of advised Kiwis say they are at least reasonably prepared for retirement. Now, this is compared to just 26% of unadvised people. So, less financial advisors, but clearly a better result occurs as a result of the financial advice. Now, we're having a discussion today with Warren Couillault, and we're going to discuss how he helped KiwiSaver businesses reach more people in the past, and most importantly, we're going to learn how he's transforming Hobson Wealth, a wealth management business, reach more Kiwis today with personalized financial advice, especially those with smaller balances to invest. Now, if you're new to this channel, I cover a lot of things, but I'm especially interested in these chats with people in the forefront of innovation in financial services. So if you like what you see today, please subscribe to the channel and like it as well to see more content. Cool, so before we start as well, I'd like to thank our partner Hatch. Now, they make it super easy to invest in the US share market. So if that's of interest to you and you don't have a Hatch account yet, check out the link in the show notes for a special offer if you're signing up from New Zealand for the first time. That's it for me. Let's get started.
Good advice for the right people leads to better outcomes, but how that actually plays out in real life changes over time.
Yep.
Let's start maybe by talking about what you do currently, and then I want to go back in time and just understand where you came from. So tell us what you do.
So at Hobson Wealth, we have a team of financial advisors who have a bunch of clients that and they impart or discharge financial advice to those clients kind of on a daily basis. What to do with their investment portfolios, big or small, whether they need to create income out of those investment portfolios. So the advisors are staying on top of the markets, looking at different financial securities around the world and selecting opportunities that best suit their clients' requirements, whether that be growth, stability or income, or some combination thereof.
And how long has Hobson Wealth been going for?
So I bought Macquarie Private Wealth New Zealand 5 years ago. Okay. So Hobson's been going for almost exactly 5 years now.
Yeah. Okay.
But the business predecessor had been there since the early 2000s.
Right. And who owned Macquarie before that?
That was owned by the Macquarie Group out of Australia, which is a huge investment bank and a multi-service bank. And they'd started a process in the early 2010s of looking at exiting their private wealth around the world.
Okay.
And we got the opportunity to look at it in late 15, early 16.
Okay.
And bought the business in, as I said, about 5 years ago.
Okay, cool. So that's a picture of what you do now.
Mm-hmm.
Let's go way back, way back. When did you first get into the money sort of space, and why did you get into it? What was interesting about that?
I had a finance degree out of Waikato University. I graduated in 1990, and at the time there was a recession in New Zealand, and there weren't too many jobs around for graduates. I was lucky enough to get a job, and then in the early 90s, the stockbrokers that had been retrenching and shrinking in the late 80s, post the crash in 87, started rehiring. The market started to pick up, activity started to pick up. So I was lucky enough to get a job at a stockbroker as an equities analyst. And that really started a stockbroking career for me for about 10 years. And I sort of progressed up the ranks, if you like, as an analyst and strategist, and then ended up with UBS in Sydney and then London. And so I was broadening what I was doing in stockbroking and equity sales and equity analysis.
What did that involve back then? So when you say analyst, stockbroking, what did they actually involve back then?
Yeah, so in the early 90s, we just started to have spreadsheets and computers,
right?
Seriously. So we did a lot of paper-based research, looking at company analysis, their prospects, their financials, financial modelling, forecasting, valuation. And then as the 90s progressed, computers came along and software and Excel, and we could do a lot more work with financial modelling with proper tools, got a lot more sophisticated. And really the role then was looking at companies that were listed in New Zealand, and then for me later on in Australia, and then making recommendations to the funds managers around the world on whether they were undervalued companies, overvalued prospective investments,
Right.
etc. And so we would look at our New Zealand client base, which was funds managers in New Zealand, and then Australia. We had a lot of interest in the New Zealand market from Australia, mid-90s. And at that time, all around the world, there were good funds, good interest in New Zealand listed equities and opportunities out of London, out of New York, out of Hong Kong and Singapore. So there was quite an international market, probably I'd say more interest than there is now. Back then, we had the big Fletcher Challenge Group, we had Carter Holt, so there was a big forestry play in New Zealand at the time. Telecom had just listed. So there was some interest in the New Zealand
So you're
market.
basically selling New Zealand to the world.
Yeah,
really.
exactly that from a listed equities point of view.
Yeah, that's cool. And so when you kind of came to the end of that, what was your next move?
So I left UBS in London in 2002 and joined Fisher Funds when it was 3 or 4 years into its very early stages of growth or existence rather. And it was Carmel Fisher and me and Carmel's husband Hugh who were the business, and we didn't have much client monies to look after. And really the idea there was for me to take my hopefully experience in analysis on that we call it the sell side, promoting and selling stocks to funds managers and to cross the fence, if you like, and to be on the buy side, which is funds management. And so I was the analyst at Fisher Funds for a while, portfolio manager and chief investment officer.
So what was that like, kind of swapping from the sell side to the buy side? Was that quite a weird paradigm shift, or was it kind of natural?
I loved it.
Yeah.
I really did like it because I'd always one of the frustrating things about being a sell side analyst or a stockbroker analyst was you do all this work and you make recommendations, and the funds manager that you're talking to doesn't have to follow, doesn't have to do what you think is right. So that can sometimes be frustrating, particularly when you're young and think you know everything.
Yeah.
But when you're on the buy side, you're making the decisions. So I'd do my own research, and we'd take recommendations from the sell side analysts, and we would make the decisions. And so I could actually put into place what I thought was right, or my recommendations.
Right.
And you could see the results of that directly with share price performance and portfolio contribution.
Right.
So I liked it.
Yeah. Okay. And how long were you with Fisher Funds for?
6 years. I finished up there in 2008, early 2008. Took a couple of years off. I bought this business, Hobson Wealth, as I said, in 5 years ago. So that was early 16.
Yeah.
So I had sort of 7 or 8 years in between times where I did a few projects.
Okay.
So I helped set up Generate KiwiSaver.
That's right. That's right.
That was one thing. I set up a fund of hedge funds, which didn't really work, so we closed that down.
Yeah.
I did some property development, property work, and a couple of other direct investments as well.
And what was your role like with Generate? Because Generate, I know a lot of our audience might actually be with Generate. I suspect, because you're one of the big players out there. So, what was your role within Generate? What did you do, and what did you find kind of unique about what they were doing at the time compared to the other providers?
So at the time, that's back in 2010 or 11, something like that. So the industry was only, the KiwiSaver market was only a few years old. I think it started in 2007. From memory, and it was heavily default provider oriented, and there weren't many sort of independent startups or smaller boutique KiwiSaver providers. So what we did was we kind of identified we need to get KiwiSaver advice out to the masses, if you like, as many people as we could. And so we set up the key founder there, Henry Tung and Sam Goldwater, set up a very, very good distribution model to get that KiwiSaver advice and the Generate product out to the market.
Yeah.
And my role there was on the board, founding investor rather, and head of the investment committee for a few years. So we set up all the investment structures.
Got it.
At the risk of exaggerating, just mentoring or being around the founders, the key founders of the business.
Because it would have been interesting at the time. I'm just thinking with these default providers that were just raking it in, or just business
Automatic.
coming to them,
Yes.
automatic. And then you have this new startup in the KiwiSaver space, Generate, who are keen to get out there, but they don't have the luxury of being a default provider, so they actually need to sell the concept of KiwiSaver, because back then it was still fairly new. Why would I want to opt into it, and why would I change? Can I even change? There would have been all of those sorts of questions. Yep. What was the distribution model, and what made that effective?
So we started thinking that we could do third-party distribution model, which was visit mortgage brokers and independent advisors and promote our product to them and our service to them for them to on-sell to their clients. That was partially successful, but what really got successful was when we did our own distribution.
Right.
So we did our own marketing, online marketing, prompting responses, prompting inquiries, and it was really trying to educate people that the default or prompt people to think about whether the only solution was the default KiwiSaver provider solution. And once we took the time to point out to people that you don't need to be with your default provider, you have a choice, and then more importantly, if you're in the right type of KiwiSaver scheme, growth versus conservative, and at the time I think 80% of the KiwiSavers were in default conservative schemes.
Wow.
Probably the wrong mix.
Yeah.
And so we were educating people directly that if you were younger with good income and you were in a growth KiwiSaver scheme versus a lower risk conservative scheme, you would probably end up, when you were retiring, with hundreds of thousands of dollars more in your KiwiSaver account.
That would have been kind of new information. That would have been a revelation or a light bulb moment for a lot of KiwiSaver members back then.
Yep.
I can actually get out. I can actually choose.
Well,
that would have
everyone,
been new.
the kind of common thought was, I have a KiwiSaver scheme and it's the same. There's no difference in the market. There is no other offers. I have a KiwiSaver like I have a bank account or like I have a post office box. Yeah. And so we went through a process of educating and talking to people, and of course they responded really well. If you tell someone that they could do better, or they don't have to be stuck where they are, or there is a choice, and you do a good job, you usually get you win clients.
That's right. And it's this weird fusion between education, you're building a business, it's distribution, it's sales. There's all that sort of stuff, but that actually creates better outcomes in the end.
Definitely.
Because people were educated that weren't educated, and unless people were innovating in that space, that wouldn't have happened potentially, right?
Yes.
Doesn't happen automatically. So after Generate, what next? That was Hobson Wealth, right? That's when you bought Macquarie and then rebranded that Hobson Wealth.
Exactly that. I think 2 or 3 years. In fact, my time at Generate did overlap a little bit with buying Hobson Wealth, or setting up Hobson Wealth after the purchase. So that was around about the mid 2010s, and then into Hobson Wealth.
Awesome.
And that's been sole focus for the past 5 years.
Okay, so describing Hobson Wealth just as a picture, just so that we can understand that in the context of, how do we actually grow our wealth, and who do we partner with as investors to grow our wealth? Yep. You tell me what it is for the everyday investor.
Yep. So we have a dedicated private wealth business. We don't do anything else. All we look after is, if you like, mums and dads and some charities and some trusts, wealth, their savings, and we've got thousands and thousands of clients that our 30 advisors look after, and we're making, as I said earlier, daily decisions on what's best to get what the clients need for their portfolios and great investment outcomes. So we don't get distracted by investment banking. We don't have a banking team. We're just private wealth. We're just financial advisors, and we don't get distracted by looking after big funds managers. Okay. We just look after mum and dad's private wealth.
Got it.
And we've got clients ranging from kind of $100,000 up to $50 million. Okay. So, and we look after everybody in that range. Okay. And that's all I want to do. I think there's a big opportunity to be a dedicated, focused, New Zealand-owned and operated private wealth company.
Where are the shortfalls, or where have been the shortfalls in terms of who the clients are that you serve? Are there people that slip through the cracks that don't get the same level of service and advice as others?
Most definitely. If you've got $1 million, which is a lot of money, you can kind of go anywhere. You can go to your bank and ask for some financial advice. You can go to a funds manager. You can go to a private wealth company like mine. If you don't have $1 million, if you have, say, 200,000 or 300,000, which is still a lot of money, and that's that person's savings, you haven't had historically the opportunity to go to a company like ours.
And tell me why, though. Because I'm interested in this.
Because it costs a lot to look after people.
Okay.
So financial advice costs, and if the more you've got, the more you've got to spend on paying for the advice. Right. And if a smaller balance like $200,000 or $300,000, it's harder to buy, if you like, that financial advice. So those investors or the people with that amount of money have tended to go to a funds manager, which can look after smaller clients, but in a scaled way, in a non-personal way almost.
So it's like choosing from the menu a couple of different funds.
Yeah, choose from the menu, choose the fund, and I'll have a little bit in this one and a little bit in that one. You typically don't get direct personal advice that we can offer. And secondly, you stayed at the bank.
Right.
And you've gone to your bank and your bank has put you in one of their funds,
Yeah.
typically, or term deposits when interest rates are a bit better.
Yeah.
And the other thing is that's one of the things that fuels the property or has funded the property market. If you've had $200,000 or $300,000, that could be a decent deposit on a $600,000 or $700,000 rental property. And again, I think that sort of circumstance is changing. So we've had a big push in the last couple of years of developing products and systems that let us get our financial advice service to people with smaller amounts.
We haven't really mentioned the DIYer here yet, but in terms of how these people with smaller balances currently behave, one of the things that I've observed, it appears to be a bit of a rise in the DIY investor because accessibility has increased dramatically, right? And it doesn't necessarily mean that always leads to better outcome. It just means that we're putting more tools in the hands of people that didn't have those tools before.
Which
is
is good.
Barriers. That's great. However, there's often no guidance apart from podcasts, YouTube videos, blogs, articles, friends and family, which sometimes can be helpful to an extent, especially if you're self-driven to learn about these things.
There's definitely a market and opportunity for that, and it's good. The example I use is if I've got a sore knee, I can go onto Google and I can do some really good analysis and find out what's wrong with my knee. But it's not as good as sitting down with an orthopedic surgeon or a specialist. And so the DIY investor, that's great. There's an opportunity and there's access, as you say, increasing access and a market for that. But there's nothing better than sitting down with a specialist advisor whose job is to look after your portfolio for the long term and give you that specialist financial advice. And financial advice and investing is part science and part subjective and part art. And so you've got to find the person that's got that balance.
That's right,
between the two, because you can't do it on one or the other.
Correct.
You need a good balance between the two.
Yeah, and I think it's quite often we kind of analyze the investment opportunity without actually looking at the investor themselves. And that's probably where the art is. That's where the interpersonal thing is, because it's like, if it was as simple as just picking the best option, well, that technology will solve that in an instant. But we know that that's not the case.
If we go back to the Generate example that we mentioned earlier, once we sat down with the KiwiSaver and gave them advice and said you can do this and you can do that and you don't need to be stuck with where you are at the moment, and here's the why and here's some potential better outcomes, you can't get that unless you're sitting with someone at the time. So.
Yeah. It's interesting, isn't it? And it like the whole phrase financial advice is I find it an interesting phrase because it means different things to different people. If you're an older person or even a younger person, I shouldn't sort of make an ageist thing, but when people come to that phrase of financial advice, often they're coming to the table with an assumption that it's actually a stockbroker and it's going to be somebody who tells me what stocks to buy. That's financial advice. But tell me why that's not the truth.
So financial advice, well, it's actually highly regulated now, and the current definition of financial advice, because it does change as regulation changes, the current definition of financial advice in New Zealand is telling someone to buy or sell a security or not buy or sell a security. And there's a broad definition of security. So any time our advisors are talking to one of their clients about buying or selling a security or recommending or not recommending, whichever may be the case, that's giving financial advice. Even if the client investor doesn't do anything, or it's kind of a broad catch-all now. Back in the old days, you're exactly right, because the source of financial advice to buy or sell a stock really was from your stockbroker. And there weren't sort of wealth managers in New Zealand 40 and 50 years ago. You'd typically go to your accountant for, what do I do with some spare dollars that I've got? They might refer you to their stockbroker friend, and it would be buy some Briley's.
Do you think that the current definition of financial advice, largely enforced by regulators, do you think that's correct? Like in terms of giving advice around acquiring or disposing of financial products, do you think that is the correct version, or do you think that there's another evolution to come in terms of what that phrase financial advice means?
It's a tricky question. It's
loaded.
Putting me on the spot. It's always evolving, as you say. We're probably getting closer to where we should be, but we'll probably never get there.
Yeah.
I think that we have, and this is one of the reasons why it's difficult to get financial advice, whatever the definition is, to people with smaller amounts to invest, because if you knew all the red tape and the background and the support that our organisations have to go through to evidence and support and control and monitor giving financial advice, even in the current definition, you realise why it's expensive and difficult, and it's sometimes difficult to access. But back to the is the definition getting better? I think it is. Does the regulator want to stop brokers and advisors having casual chats with their clients? Probably not. Does the letter of the legislation say because we've got to monitor and record and control everything we do? So it means you sometimes just have to be careful with what you do and say. Is that the intent? No. So there is probably a review of the scope of the definition of the advice.
Because I know, from my personal perspective, I firmly believe that there's a lot of creativity that's missing from the financial advice community. Yep. Like, to be blunt, it feels like it's almost too restricted, and for good reasons. A lot of it is just pragmatic, right? You can't. It just doesn't work like that. But when you're eyeballing someone and you're giving them advice on anything because you've gone through it first, sometimes that's not going to be within the letter of the law. And I'm not suggesting that financial advisors have to break the rules here, but
definitely not.
Somehow it feels like there needs to be more space for the creative element to grow. You know what I mean?
Yeah, I also think that New Zealand as a whole, the New Zealand investor base is relatively unsophisticated compared to the US, UK, Australia even. They're much deeper financial markets over there, much broader, much wealthier, bigger, and have been around and developing a lot longer and a lot earlier than ours. Yeah. We're kind of catching up, but in terms of the creativity of different financial products and different investment products, but we're years and years behind the development that's happened in those markets.
Yeah.
So that's just time.
Yeah.
And the size of the market that we've got. And I think KiwiSaver, when that came along, as I said, in 2007, it's now, I think, $60 billion or something like that. It's pretty big, but it's nothing compared to the size of the superannuations or retirement savings pools in those other economies and bigger, broader markets. Bigger, broader markets bring with it different financial products and more creative financial products that suit different investors.
Okay.
And so size and understanding and education and sophistication in New Zealand market will bring that over time.
Okay.
Not quite yet.
Okay.
And we see it all the time in our business. We get different products promoted to us, and sometimes there's some appetite among our investor base. More often than not, there's not a lot of appetite.
Right. Okay.
And I think also another reason for that, certainly in the last 10 years, is we've pretty much had a one-way bull market since the GFC back in 2008, with almost all asset classes behaving really, really well. So the New Zealand investor market hasn't tended to have to look elsewhere.
Correct.
It's going to change.
Correct.
Because we won't always have a one-way bull market across all asset classes, and with interest rates so low, at the moment you think where's the bond market going to go? Can it continue to go up? Which we've had for a long time. So people will, over time, have to look around and be more creative with their advisor.
And I guess that's where, like you say, with the bull market, everything's looking great. So it almost hides underperformance. It hides bad advice, dumb decisions, because you just wait, and everything that you do, within reason, seems to increase a little bit. And so it kind of hides the fact that you can be making dumb decisions. But during a normal market or a changing or transitioning market where it's come off a bull run, that's probably where you see the value of being strategic a lot more, right?
And having quality financial advice, and we don't want to overquote Warren Buffett, but to quote Warren Buffett, when the tide goes out, we see who's swimming naked.
Yeah, that's right. Yeah,
and we've had the tide coming in for a long time. And as you say, once it starts to go out and all markets aren't moving in the same direction, then we'll see the quality of people's portfolios, and you will definitely see the benefit of financial advice and diversification.
Correct.
Of different products.
Correct. Yeah, because the diversification, portfolio construction, that's largely going to be an outcome of receiving some sort of advice.
Correct.
Or luckily landing in the right thing, but probably more ongoing advice and rebalancing along as you go.
Yep.
So how have you guys solved this problem then? So the problem is that, often people get ignored up to about $500 or $1 million. How have you guys specifically solved that problem to give a higher level of personalized advice to people with smaller balances?
Yep. We have an investment team that create model portfolios on New Zealand equities, New Zealand fixed interest, fixed income, and international securities.
Okay. Break down what that is then. So what is a model portfolio?
Oh, it's a best ideas portfolio and a portfolio that's designed to outperform the respective benchmark. Okay. So for the New Zealand equities portfolio, for example, we get our best ideas from research that we buy, research that we undertake ourselves, and we create a portfolio that with the characteristics that we like, would at least, we would hope, perform as well as a passive investment in the New Zealand NZ50.
Okay.
So we try to do better than that. We try to have yield as well, and we try to have relatively less beta or less movement relative to the market than the market portfolio.
Okay.
And so on into other asset classes
okay, so
as well.
Better return, less risk. You've chosen...
Hopefully.
Hopefully,
yeah.
And you've chosen a specific portfolio
Yep.
for a certain type of client,
Yep.
and then that portfolio is a model,
Yep.
which you would then match with the right type of investor. Is that right?
Correct. So our investment team creates a central portfolio, and then the beauty of what we do at Hobson Wealth is the advisor takes that model portfolio and fine tunes it to the investor's requirements.
Right.
So it's not a cookie cutter. Not everybody gets that model portfolio. The advisor and our model lets the advisor tweak that, if you like,
Sure.
to suit the client's circumstances.
So I'm building a house. I'm going to one of these big, GJ Gardners or whatever, and they've got their model home that you can buy, but you can change the type of kitchen and the carpet and stuff like that based on your preferences.
Exactly. And so we're creating these model portfolios across asset classes, and we're creating asset allocations across the different asset classes to suit different types of investor, high growth to defensive, and lots of things in between. So what we've done to get that advice or to get that information and model portfolios, if you like, to the smaller investors is we've bunched those different asset classes into our own managed funds. And so if someone comes along to us with $200,000, we can do a risk assessment. Are they trying to grow that in the long term, or do they need it to be pretty safe in the shorter term to generate income? And we can combine the funds that we run into a specialist combination to suit that investor's circumstances.
Right.
Without that, they would come along to us with $200,000, sit down with an advisor would try to get some securities together. But the smaller the balances, the harder it is to buy lots of direct securities.
At a lower cost.
You need scale,
right? Yeah.
at a proper cost.
Yeah.
It's too expensive. You can do that in the funds that we run. Or they would outsource that to third-party funds managers.
Right.
So we do it ourselves based on our own best ideas.
Right.
So our investment team gives best ideas via model portfolios to the advisors who tweak that for their clients. They also put that straight into the funds that I run, and we can offer that in the right combination to the smaller investor.
Right, because the biggest, one of the biggest components that influences the cost, presumably, is actually constructing it, everything in a bespoke manner, right? And kind of assembling every little piece. Yep. Whereas now you have this model thing, which you're just tweaking a little bit, therefore you're spending a lot less time on it.
Yep.
So the advisor could then spend time talking to the investor rather than talking about the investment.
Yep.
And better outcomes.
And transaction costs. We try to minimise transaction costs because they, on smaller portfolios, if you've got $200,000 and you're trying to get a diversified portfolio around the world, you probably need 30 securities. So the per security amount on $200,000 is pretty low, and with minimum execution costs and holding costs, it gets prohibitive, or inefficient.
Okay.
But if you put that $200,000 into a combination of bigger funds where there is scale, and the transaction costs and holding costs are low, you can get that diversification. Without incurring the cost.
Okay. So kind of going back a little bit to what we were talking about before, I just want to get a feeling for the landscape in New Zealand and who are the main players and how the players are kind of moving around and exiting and entering, all that sort of stuff. So
in financial advice.
Yeah, correct.
Yeah. So what we've seen is previously banks broaden their services from offering debt products to insurance products, financial advice products. And the regulations tightened to an extent, probably coming out of Australia, but into New Zealand as well, where the banks are sort of frowned upon if the banks cross-sell too many different products to their unsuspecting customer. I hope that doesn't get me in trouble with the banks, but they've had to be careful about incentive schemes and rebates and the financials and transparency of selling different products to different bank customers. And that's led to a lot of the banks exiting or scaling down non-core bank products that they offer consumers. So last year, Westpac sold its Westpac Private Wealth division. I think ANZ sold it a couple of years ago, and we're going to see more of that, and insurance as well.
Yeah.
We're going to see more of that as the banks get back to a bit more core product. And the capital allocations and requirements for banks make it harder to,
Right.
And weightings of the capital make it harder to do anything other than core banking.
Right.
Particularly for the return they get or don't get. So what that means, and we're also seeing the big global investment banks tend to leave New Zealand as well.
Right.
So, and certainly in sort of mainstream space. So we don't have Goldman Sachs as a owner of wealth and stockbroking anymore in New Zealand. Citigroup is down to investment banking and custodies, so non-stockbroking and non-wealth.
Yeah.
And so that kind of looks like, to me, like a Deutsche Bank exited earlier this year from its partnership with Craig's. So we're seeing a return of the advice industry, if you like, or the old stockbroking, now financial advice, to local ownership. And so the core group of participants are Jarden, Craig's, JB Ware, Forsyth Barr and ourselves.
Right.
Jarden's 100% New Zealand owned. Craig's is 100% New Zealand owned by the staff.
Yeah.
Forsyth Barr's the same. We're the same.
Yeah.
Macquarie Group has a small percentage of us, but by and large it's New Zealand owned.
Yeah.
And who have I left? JB Ware is owned by National Australia Bank.
Right.
So overall, the financial advice industry tends to becoming local again.
Interesting.
Which
Okay.
is it is interesting.
Yeah, that's going to be good and bad, right? It means that more opportunities to innovate, I'd like to think, but less ability to draw upon stuff from overseas,
Global
right?
expertise, yeah.
Yeah.
Well, most of us do have arrangements with global banks. I've got an arrangement with Macquarie Group.
Right.
I've got an arrangement with Citigroup where we access and buy some of the services that they can offer.
Right.
We use BNP, for example, as our global custodian to safeguard and hold
Okay, I
our
was wondering about
client
that.
assets.
Yeah, okay.
So we're not. The actual core advice is probably from New Zealand-owned operated companies.
Yeah.
But of course we've got relationships and partnerships with global players where we all need to.
Okay. Now let's talk about who the players are in terms of the actual boots on the ground, right?
Yeah.
And I'm keen to understand whether or not the demographics, the skill set, the nicheness of it all in terms of the financial advisors themselves. I want to understand if they're changing over time and where you see that going. Like, are they getting younger? Or are they kind of static? Is it hard to get people in the industry? What's happening?
I think because the cost of getting financial advice to people tends to go up with increasing regulation and increasing compliance costs, it tends to lead the industry to service larger clients.
Right. So regulation kind of supports that model
I
of
think so.
targeting to the higher ones.
And
Yeah.
larger clients tend to be people who are a bit older, who've had opportunities to make money, to create wealth, buy and sell businesses, build businesses up, property, whatever the source is. And they tend to attract advisors who are a bit older as well.
Of course, makes sense.
Been around the block,
Yeah.
got some experience, talk the same language,
Yeah.
have the same interests. So I think it's an industry where overall there's some rejuvenation, there's some younger people coming into the industry, but I think the average age of the advisor, and certainly out of my peer group, is in the mid to late 50s.
Interesting.
And that tends to be reasonably top heavy in that demographic, if you like. The number of advisors is shrinking. Financial advisors is shrinking in the market, and I think a lot of the sort of one-man bands, if you like, or sole operators, I should say, are finding in the last few years cost of regulation, cost of compliance, conforming too much, and so they go elsewhere or do something else. And so we tend to, and as I said, that the banks are leaving the industry, so there's not a natural market for people coming into the industry via the big banks. So I think we're seeing sort of a bit of a concentration of financial advice among the independent specialist New Zealand-owned now financial advice groups, names of which I mentioned earlier, and it's up to us to sort of rejuvenate and keep a good flow of new younger people coming into the industry where we can to fit that with our client base.
Right. I'm thinking right now we've got these baby boomers that are starting to consume capital. Eventually they're going to die. They're going to leave an inheritance. It may or may not land on the Gen X's, or it may go straight to their grandkids, right? And as the wealth, as that bubble or that bulge of wealth slowly moves down the demographics, like, are you kind of anticipating that there's going to be a rise of any other types of advisors? And you know, this is where I guess the digital advice kind of sneaks in here. But you see, like, what's next, I guess, is what I'm saying.
I think that digital advice has been around overseas for a long time. It's slow coming to New Zealand, but it is coming, it is here, and that will be a big part of how those younger generations, seek financial advice. Having said that, like I said before about me sitting down analysing on Google my sore knee, there's nothing better than sitting with a specialist orthopaedic surgeon or a knee person. Yeah. And I think it's the same thing. The people will go online and they'll get some digital financial advice. But if you've got larger sums of money, it's your life savings, it's your inheritance. You are going to always want to sit down with a specialist because it's part science and part art. Yeah. And you can only get that from a person. Yeah. So I think there's room in the market or the industry over time for lots of different channels for getting advice.
Yeah, I think so.
But there's room for the core traditional financial advisor.
Yeah.
It doesn't mean to say advisors in our business, for example, don't need to upskill, don't need to innovate, don't need to look at different products and be more creative. Of course we will, but that personal contact and personal relationship will always be valuable.
And you mentioned how you guys are using model portfolios to serve those smaller balance customers more efficiently and effectively. Do you see that digital advice will become more and more part of that equation, where now personal advisors, where they're providing the art part of it, the science part is taken care of more with digital advice tools?
Very much so.
Yeah.
Yes.
Yeah, because that's going to be, I think, you know, when I stand back and I look at this and I see how landscape is changing, there seems to be still, like you say, a high concentration of personalized advice for those with higher balances, either very low or automated. I wouldn't even go so far as to say it's digital, or no advice for the DIY smaller investor just getting started, right?
Very much so. And so where do you go if you've got $100,000 that you've saved?
Yeah.
You can look online and you can get a whole list of providers, you can get a whole long list of funds managers. Yeah. How do you know which one to choose? You go and dig around and you look at some ratings and you look at some historic performance. But how do you know that the fund or a couple of the funds that you choose are the right ones for you?
Correct.
For what you're wanting to do over 5 or 10 years or whatever your investment frame is. Yeah. You need some either digital advice to do that, or a person.
Yeah. So if we were just to fast track now as we wrap up and we think about what does it look like, say, in 10 years' time? So we're sitting in 2021, 2031. What does it look like for the 45-year-old in 10 years' time? So the 35-year-old today and 45 years old in 10 years' time. What does it look like for them? What do you imagine, if you can kind of just put aside what you already know about the existing, what do you see happening in the future? How will someone actually access advice in the future?
So the 45-year-old will have a great KiwiSaver balance because they're now 10 or 15 years further on from actually starting that, so that's good. There'll be more providers of KiwiSaver services, and I'll come on to their wealth or non-KiwiSaver assets in a second. So there'll be more KiwiSaver choices. Yeah. There'll be, as you said, some more creativity and a wider range of sophisticated products, and there'll be a easier ability to switch, get information, etc. So I think that'll just continue to develop and enhance.
Yeah.
If he or she has a lump sum balance of savings outside of KiwiSaver, there'll be a number of digital advice platforms, a number of digital product platforms, but there will definitely be humans to talk to and humans to get advice from as well.
Do you see that the KiwiSaver providers will move more into that space?
I think that the larger I think the innovation will come from smaller KiwiSaver providers who will see opportunities in between over the next 10 years to provide advanced, innovative services
I agree, yeah.
to pick off, if you like, or win customers from larger organisations.
Yeah.
Sometimes when you're a large organisation with a big balance of investment funds, you kind of get sometimes a little bit sloppy about your client service,
Right.
about your innovation.
Right.
We've all been there.
It's harder to move a big ship, right? Yeah.
Yeah, harder to move a big ship. I don't mean that in a bad way.
Yeah.
Definitely harder to move a big ship. And the younger, more innovative players can come and just pick off parts of the market.
Yeah.
That's probably where we'll see the innovation.
Yeah, cool. And overall, net positive about the future?
Oh, very much so. We've had slow but increasing participation in capital markets in New Zealand in the last 10 or 15 years. We have increasing wealth slowly again in New Zealand. A long-term KiwiSaver or a long-term savings structure.
Yeah.
Didn't have that many years ago. So I think there's lots of reasons why the financial markets in New Zealand have a pretty positive future.
Yeah.
And there's an increasing understanding among people that you do need to save for your future.
Yeah.
And you do need to put some thought into it and how am I going to get the best outcome.
Yeah.
And as an industry, we're going to provide good alternatives and hopefully generate good outcomes for people over time.
Okay. One more question. Do you see that as going to be a huge boost to those seeking to grow wealth outside of property because of increasing regulations with investment properties in particular?
I don't believe the increasing regulations targeting rental investment or investment properties will last. It can't. We need a stock of rental property to meet demand from renters. So that might be a little short-term blip. I think things will normalise. But over time, I think people are slowly but surely realising I can't put all my eggs in the property basket or one basket, or maybe I shouldn't. And I can't keep my money in the bank because I don't really get a meaningful return. Yeah. I need to look elsewhere. And that's certainly what's been a part of driving asset prices in the last few years, that continued drive down to zero almost in interest rates, and property prices have benefited from that as well, but financial assets as well. And that will definitely continue. As I think with the sophistication and understanding of investors as well, we need to broaden, we need to have other investments, and there's other opportunities other than the term deposit and the rental property.
That's right. It's certainly, with what's been happening this year, it's been a fantastic way to get people to at least consider walking across that bridge,
Very much
right?
so, yes.
No, that's awesome. Well, thanks very much, Warren, for your time today. And if people want to find out a little bit more about Hobson Wealth, where would they go?
So our website's www.hobsonwealth.co.nz.
Cool. Fantastic. Thanks very much.
Thank you.
Cheers.